Imagine you're standing at a massive airport. Planes are taking off, each carrying people toward destinations. Some unknown, some luxurious, some risky. Now imagine those planes are your investment choices. Tech stocks, volatile weather, meme stocks, they're flying with no flight plan. But financial stocks, these are your steady, fuel-efficient long haulers. Boring, maybe? Profitable? Oh, absolutely. Here's the thing. While everyone's distracted by the flashy takeoffs, the real wealth is often made quietly by those who invest in the engines of the global economy. Banks, insurers, payment processors, and credit agencies. And right now, some of these giants are not just reliable, they're massively undervalued. That's like getting first-class seats at economy prices. So today, we're diving deep, not into theory, but into the actual best financial stocks you can own right now in 2025. These aren't guesses. These are backed by data, fair value estimates, and serious analysis. Ready to invest smarter? Let's board that flight. Number 1. Western Union WU. Western Union isn't just the company your uncle uses to send money abroad, it's a heavyweight in the global remittance game. And yet, it's trading 50% below its fair value estimate. Why? Well, it's no secret that the rise of digital payments spooked investors. Fintech startups burst in with slick apps, flashy ads, and zero fees. Western Union, once king of the cash corridor, looked old school, like Blockbuster watching Netflix from the sidelines. But here's the twist. They've been quietly rebuilding. They slashed prices where they were bleeding market share. They've gone digital, fast. And they've still got one massive ace up their sleeve: scale. Over 500,000 agents worldwide. That kind of global presence isn't easy to replicate, no matter how many coding boot camps your startup went through. Their digital transfers spiked during COVID, and while growth has since cooled, the company is investing heavily in modernizing that arm. Add in an 11% dividend yield, and you're looking at a mature, stable cash machine turning the ship around. Not sexy, but stable, and sometimes that's exactly what you want. Number 2. TransUnion TRU. Now let's talk about the quiet brainiacs of finance, credit bureaus. TransUnion may not be a household name like Apple or Amazon, but it powers decisions that touch nearly every American adult. Loans, mortgages, even rental applications. Yeah, TransUnion's behind that curtain. What makes TRU stand out is its wide economic moat, a term Warren Buffett loves. Basically, it's got such a strong edge, it's hard for competitors to break in. TRU is trading 23% below fair value. And it's not just sticking to lending anymore. They're expanding into insurance, collections, rental screening, and even internationally. India is their next big frontier, and they've already planted their flag with a dominant early lead. Plus, they've been acquiring smart, snapping up digital marketing data firms and global credit bureaus like a player collecting power-ups in a video game. It's smart scale building, not reckless empire building. Want a stock that offers steady margins, scalable data, and long-term growth potential? TransUnion's your play. Number 3, Prudential plc, PUK. Prudential isn't your grandfather's insurance company anymore. Founded in 1848 in the UK, this legacy name reinvented itself. It sold off its UK and US assets and went all in on Asia and Africa, 2 regions where the middle class is growing faster than TikTok trends. Here's why this matters. In those regions, life and health insurance isn't saturated. Prudential's serving a rising population that's hungry for financial security, protection, and wealth building. Now, is it the biggest player in Asia? But it's smart and disciplined. It's gaining ground by balancing growth with underwriting quality. It's not reckless, and that's a huge plus in insurance. Trading at a 22% discount, Prudential is betting on long-term structural trends. And if Southeast Asia becomes the insurance capital of the next 2 decades, Prudential could become the crown jewel. Oh, and a modest 1.84% dividend sweetens the deal while you wait. Number 4, PayPal, PYPL. Ah, PayPal. Once the darling of digital payments, spun off from eBay, it soared during the pandemic. But as online spending slowed and Apple Pay nipped at its heels, PayPal stumbled. Now, here's the opportunity. The stock is 22% undervalued, and the company's pivoting toward more profitable growth. They're trimming fat, boosting innovation, and pushing features that aren't just gimmicks, but potential cash cows. Think Braintree, which is quietly gaining traction, and Venmo, which still hasn't been fully monetized. Yes, PayPal faces threats on both sides. Merchants have new options, and consumers have phones full of payment apps. But it still holds a unique position. And remember, it has massive merchant networks, solid consumer trust, and is expanding in in-person transactions too. There's risk here, but also massive upside if management pulls it off. It's not a sure thing. But smart investors love asymmetric bets like this. Number 5. Rowe Price Group, TROW. Rowe Price is a little like your favorite uncle who always wears the same blazer, but somehow always has great stock picks. This is a classic asset manager in an age where passive investing has taken the spotlight. And yet, TROW is one of the few active managers with a respectable track record, reasonable fees, and a focus on retirement accounts, which means sticky clients who don't pull their money at the first dip. Trading at a 16% discount, and with a dividend yield over 5%, Rowe is a dependable performer. Yes, there are headwinds. Passive funds are cheaper, but retirees still value guidance, performance, and relationships. 3 things Rowe does better than most. This is a long-term bet on active management staying relevant. And for dividend investors, it's a gem. Number 6, BNP Paribas, BNPQY. Let's hop over to Europe for a moment. BNP Paribas is France's biggest bank and arguably one of the most underrated giants in global finance. Trading at a 16% discount, this is not your average bank stock. BNP has weathered tough times, low interest rates, volatile European markets, intense competition. But through it all, they posted stable earnings for over a decade. That's rare in banking. As rates normalize, BNP's return on tangible equity is climbing. And unlike many of its peers, it's doubling down on investment banking, a space where European banks usually flinch. This gives BNP a unique edge to compete with US titans like JP Morgan. Add to that France's bancassurance model, which combines banking and insurance under one roof, and BNP can capture more value per customer. It's global, it's diversified, and it's quietly strong. Exactly the kind of stock smart investors love to tuck away for years. Great! Now that we have all the reference material, let's continue with part 2 of the script in the same style, tone, and voice as part 1. This continuation will cover the remaining financial stocks from your list, keeping everything natural, human, engaging, and informative for a long-form YouTube video. Number 7. US Bancorp, USB. When it comes to regional banks that punch way above their weight, US Bancorp might just be the Floyd Mayweather of the financial world. No flash, all fundamentals, and the results speak for themselves. With a wide economic moat and a 15% discount to its fair value, USB isn't just surviving, it's thriving. This isn't your typical corner bank. It has a diverse set of fee-generating businesses, payments, wealth management, mortgage banking, you name it. It's like the Swiss Army knife of banking, and it's efficient. Over the past 15 years, US Bancorp has outperformed most of its regional peers in returns and operational smoothness. While others are still figuring out digital strategy, USB is expanding its payment ecosystem with tech investments, bolt-on acquisitions, and new partnerships, including with State Farm and Edward Jones. Yes, competitors are catching up, but with new CEO Gunjan Kedia at the helm, focusing on payment innovation and cost discipline, 2025 could be the year USB pulls even further ahead. Oh, and did we mention the 4.46% dividend yield? That's a nice little bonus while you wait for the long-term upside. Number 8, Ally Financial, ALLY. Ally Financial is the bad boy of banking, in the best way. Spun off from General Motors, Ally is now a major player in consumer auto lending, and it's currently trading 15% below fair value. Here's what makes Ally interesting. It's digitally native with 88% of its funding now coming from customer deposits, up from just 54% in 2016. That's a huge shift, and it's made Ally more profitable, nimble, and ready to compete in a world where physical branches are going extinct. But let's be real, auto loans have taken a hit. Credit losses are up, used car prices are down, and that means Ally's margins have been under pressure. But management saw it coming. They've tightened underwriting, and the used car market is stabilizing. They've sold off their credit card division and are letting go of some mortgage exposure, streamlining for the long haul. This is a classic storm now, sunshine later story. If you believe in the US consumer recovering, Ally could be a sleeper growth pick in your portfolio. Number 9. Market Access, MKTX. Want to own a stock that benefits every time a corporate bond changes hands? Meet Market Access, Wall Street's go-to for electronic bond trading. This fintech powerhouse has a wide economic moat and is trading 14% below its fair value. It's the Amazon of fixed income trading, but without the trillion-dollar market cap. Yet, they dominate the corporate bond space, including a big chunk of emerging market debt and Eurobonds. And as the world shifts from voice calls to digital platforms, Market Access is perfectly positioned to win big. Their open trading network is growing, and they're investing in smart tech like automated execution tools. Now, they did lose some market share in 2024 to competitors like Tradeweb and TrueMid. But that just lit a fire under them. They're doubling down on innovation in 2025. If they can defend their turf and scale up in treasuries and municipals, this stock could fly. Yields light at 1.36%, but the growth runway? Massive. Number 10. Zion's Band Corporation, ZION. Zion's is the blue-collar workhorse of this list. No moat. Modest growth. So why is it here? Because sometimes value hides in plain sight. And this regional bank is trading at a 14% discount to fair value. Zion's operates across 11 Western states and specializes in commercial banking. It's exposed to interest rates in a way that gives it a tailwind when rates are high. That means more profit, faster every time the Fed gets hawkish. They've had problems in the past, especially during the financial crisis. But today, Zion's is leaner, more diversified, and better managed. Credit risk is down, deposit bases are stabilizing, and they've started to rein in their bloated expense structure. Do they still have efficiency issues? Yep. Are they actively improving? Absolutely. This is a classic wait-and-watch stock for investors who like to bet on turnarounds with a strong regional footprint. And with a 3.43% dividend, you get paid while it proves itself. Number 11, Invesco, IVZ. Invesco was once the golden child of asset managers, diversified, fast-growing, and digitally savvy. But lately, it's been more of a problem child. Trading 13% below fair value and yielding a juicy 5.5% dividend, Invesco looks tempting. But make no mistake, this is a value play with baggage. They botched their 2018 acquisition of Oppenheimer Funds, lost ground on FE realization, and failed to keep pace with industry trends. Fee compression hit them hard, like 6 years in a row hard. But there's hope. Their margins are starting to rebound, and the business model has strong operating leverage. If markets keep climbing, Invesco will benefit fast. But for long-term upside, they'll need to fix their pricing strategy and find new ways to grow AUM. So if you're chasing yield and patience, Invesco might surprise you. Just don't expect fireworks overnight. Number 12. Keycorp, KEY. Let's wrap this up with KeyBank, a regional bank that's had a rough ride but might just be positioned for a rebound. With a 4.89% yield and trading at a 13% discount, Keycorp offers a compelling mix of stability and upside. The bank has been focused on middle-market investment banking, digital retail banking, and payment tech. Not bad for a mid-size player. The 2016 First Niagara acquisition gave them scale, but 2023 was rough. Bad hedges, rising rates, and interest income pressure. Still, those same hedges roll off in 2025, giving them room to breathe. Plus, they've reinvested proceeds from Bank of Nova Scotia to juice up their yield profile. The real story here is strategic diversification. They've got banking, payments, advisory, and a growing digital arm. And if they hit their NII growth targets for 2025, you're looking at a quiet comeback kid that'll reward long-term investors with a mix of income and upside. Drop your thoughts in the comments. Smash that like button if you got value today. And make sure to subscribe so you never miss a chance to invest smarter, not louder. And don't forget to hit that bell because timing, well, it's everything in finance. See you in the next one.